All right. Hello, everyone. I'm super sorry for all of the some of the technical difficulty there with the Zoom link. But for everyone that is on, thank you so much for joining us. Just a quick overview. Today we're going to be going over short-term rental tax strategy. So some background. I'm Dave Menapace, president of Launchpad Consulting, where we help launch folks short-term rental properties across the country and help support them on the back end. And we also own Five Star Co-host, short-term rental property management company. Now, a little bit of background here. About a year ago, Kim and I decided that we really needed some help on the tax side of things, not just like with filing and bookkeeping and things like that, but really pointed tax strategy. And for that, we sought out Hall CPA, and we were paired up with our guest speaker today, Ryan Carriere. So Ryan is a senior tax advisor with Hall CPA, and he's really helped us. Just going to put a few folks on mute. He's really helped, really, he's been a partner for us whenever we're going to make a big financial decision or really any decision at all, big or small. He's the first person that we run that idea past because we really want to understand what the tax implications are and how we can leverage our assets, but also our businesses that we have so we can make the right financial decisions that really mitigate our tax burden. Not that we're against taxes and don't want to pay them, but we just want to understand all angles of the financial decisions that we make. So, with that, I've asked Ryan if he wouldn't mind coming on and sharing some information with everybody. I think almost everybody here owns a short-term rental, or they're managing other people's short-term rentals, and having this type of information is going to be really helpful. So, with that, Mr. Ryan, welcome. Welcome to the show. Welcome to the group. And want to just give a quick overview of yourself, and then we'll just jump right in.
Yeah, thank you, Dave. Yeah, I'm Ryan Carriere, work at Hall CPA. We're also known as the real estate CPA, so some of you might know us as that. That's more so kind of our almost trademark kind of business name, doing business as name, but kind of legal name is Hall CPA. But yeah, we are just like it sounds, the real estate CPA. Just to like break down our firm, it's real estate and it's CPA. So who we help is the real estate part. We only help real estate investors, period. That's our specialty and that's kind of our niche, and that's why Dave and Kim reached out to us. The CPA part is kind of how we help real estate investors. So we do tax consulting, we do tax preparation and accounting. So that's kind of the short of kind of who we are as Hall CPA. Me personally, I'm sitting in kind of the Minneapolis, Minnesota area. I know Kim mentioned I've got my kind of sweater on. It's somewhat cool, but I had my smoothie this morning that made me more so cold inside than it was on the exterior. But yeah, I've been a CPA for several years, probably coming up to 10, but essentially kind of moved into the specialty of just real estate over the last probably 6 years or so, and just kind of was always kind of attracted to our firm because we really specialize in that. And when you get really specialized, you can get very, very good at just one thing. And now people come to us just for that. And so we help people like Dave and Kim, people like you guys who are listening, really thinking through, hey, I've heard real estate can be tax efficient. What does that mean for me, right? We have a lot of information. We've got blogs, we've got podcasts. We're at almost episode like 290 or something like that. We're the number one tax podcast in the US for real estate investors. So go check that out. Again, YouTube channel, all these things we post on social media. I post on LinkedIn pretty much every day. So lots of places to find us, even outside of just this quick 45 hour long call. But that's a little bit about me. Anything else, Dave, you think I should say?
No, I love it. I love it. And so what we're going to ask folks is, just like what happened to Kim and I, when we started meeting with Ryan, we had a million questions. So all we ask is that, Ryan's going to do his thing. I ask that you just post the questions into the chat, or raise your hand, and then like I can kind of help inform Ryan, or we can just we can sort of organize when we're asking the questions and answer them the most efficient way. But plugging them in the chat is probably going to be the best way to start out. And then when there's a break in what Ryan's saying, we can pause and tend to those. So unless specifically called on, just try and stay on mute. We do record this and put it into the school platform for any of our clients or clients of our consultants at Launchpad. So you'll be able to watch it over and over again. Your own clients will be able to watch it over and over again. And of course, we'll end the session giving Ryan's contact information. Kim and I can't say enough great things about working with Ryan and working with Hall CPA. We also have them do our tax filing. And so pretty much everything is under one umbrella. So if you want any introductions, by all means, we'll make sure you have a way of reaching out to Ryan, or if you just have a follow-up question, something like that. Um, so with that, want to take it away, Ryan?
Yeah. So way I like to start any sort of, webinar, podcast, whatever, if it's like, hey, you're a guest, where do you start? I like to start with a little bit of kind of the context and where we've been. So the thing I always like to start with is the passive activity loss dilemma, right? And I think as Dave and Kim, that was kind of one of the things that we really started with too, because it's so important to really nail that down first. And where does like real estate fit into? Why is this such an issue with losses that we get from rental properties? And having that, for example, right, the goal usually for most people is offsetting that W-2, right, being an employee, that income, or if you are a business owner like you guys too, offsetting that business profit. The default is really you get to a point where you make too much money where the losses from rental properties cannot offset that W-2 in business profit. So that's usually the big dilemma. And so the IRS, our lawmakers, really put that into play back in, it's roughly the 1986 huge tax reform act that came out almost 40 years ago. And so basically that was kind of what they said. They basically noticed all these doctors, all these really high income people were just taking losses from their rental properties and then offsetting that against their W-2. And they said, we got to put a stop to this, right? So now they made this distinction and said, hey, by default, rental properties are considered passive. And I'm going to kind of use this hand over here. Kind of imagine we're going to like split my hands here. So passive is rental properties here by default. Now, all of your other income, essentially W-2, business profits, is all over here. And they basically said rental losses, passive losses cannot offset that W-2 business profit. Okay, that was the default. However, right, and that was the issue. However, they said, but, and these actually exceptions came out later after the Tax Reform Act came out, and they said, but there's two ways to get around that. One is using something called real estate professional status. REPS is kind of the acronym that we use. And just to note here, I'm not going to spend a lot of time on that because this is a short-term rental group, but really that is for long-term rentals. Okay. This is a short-term rental group, so that's for long-term rentals, not going to spend a lot of time. But the second one was the short-term rental strategy. Some people call that the loophole. Some people hate that word loophole. So be it, that's just a marketing thing, right? That's what it is. Okay. So the short-term rental strategy was one way to solve the dilemma to say, hey, we've got short-term rental losses. How can I have that offset over here, my non-passive W-2 or business profit? Meet the short-term rental strategy, right? So then we move into, okay, what is that strategy, right? There's some requirements in order to do so. And essentially, the simplest way to say it is it's two steps, okay? And Dave, feel free to pause me as we go if you're like, hey, let's talk about this first. But I'll
Sure.
start here and then I'll pause. So the first step is fairly simple, and it's that the average stay per guest at your property is 7 days or less. Really common for a lot of Airbnbs, VRBOs, vacation rentals, right? Most of you, if you've got kind of this higher end vacation spot and you're in a vacation destination area, you're probably getting more like 3 to 4, right? You're just kind of doing weekend stays. Maybe it's even closer to 2, 2.5. So that's very common. Boom, that's step one. Now, the nuance that I'll just explain now is that some people might think, well, oh, cool, I just need to have an average stay. I'm just going to wait till the end of the year, get one stay, and then I'm good. No, you have to have 2 stays. Okay. You have to have a minimum of several stays to show and get to what is an average. You think of the word average, we've got to have several stays to show intent. Okay. There's a whole strategy people will try to think through of, oh, I'll just do that the first year, and then the second year I'll change it to a long-term rental. We don't think that's going to work. Okay. Huge risk doing that. Please be careful. Okay. But the first step, again, bringing it back to the basics, average stay per guest is 7 days or less. Okay. Now, the second step is material participation. Probably a lot of you who maybe follow other tax people online have heard of this. And at the end of the day, to break it down as simply as possible, there are 7 material participation test options. I'm only going to talk about 2 of them because the other 5 are generally not used very much. And so it's just not worth the, 35 minutes we have here to discuss all of them. So the only 2 I'm going to talk about is number 1, 100 hours and more than anyone else test. Okay. And remember, you only have to meet one of the 7 tests to say, hey, I'm at step 2, material participation. 100 hours and more than anyone else. And the second option there that we'll talk about today is the 500-hour test. Okay. Now, just to break down those a little bit further, and then I can pause and see if you think what I should talk about anything else. But the 100-hour test, the comments I usually like to explain is that it is you as the taxpayer. Okay. Could be if you're married, you could be you and your spouse, right? So Dave and Kim, right? They could accumulate a minimum of at least in the tax year 100 hours. But part two of that is you have to make sure it's more than any other individual person. So who is that? It's literally anyone else who works for your property. A cleaner, a handyman, contractor. If you've got a property manager, right? I think some of you on here do have property managers. Some of you don't. You self-manage. There is a distinction there that we can talk about. But basically, you need to say, hey, I've got this much time, right? Kind of using my hand as a bar chart. I've got, say, 150. My next closest person is the cleaner who only got 125 hours. That's fine. Okay. Let's say the next closest person is a handyman who got 95 hours. Still fine, right? If everyone else is less than you on this theoretical with my hands bar chart, you're fine. Okay. Now, the nuance there is you have to keep track of everyone's time. That can be a little bit of an administrative nightmare, but we can talk about that. Okay. We can talk about that later. But just to move on, the second test, again, remember, it's just one of these you need to pick from to say, hey, I meet material participation. The second one is the 500-hour test, period. The reason I use the word period is because on the other test we just talked about, there was a little bit more, right? It was 100 hours and more than anyone else, right? This is simply just 500 hours, period, end of story, right? So the point is if you guys get 510 hours, you don't even have to look at anyone else's time. There's no comparison. So in that situation, one of the unique strategies could be, I've got 510 hours, but I've actually got a property manager who got 1,000 hours. Hey, that's fine. You got material participation. Our lawmakers say that's just fine. So there is some strategy in there when you can use simply that 500-hour test. So if we meet, right, two steps, average stay test, less than 7, in one of those two that I talked about, material participation tests, now that short-term rental, or if you've got multiple, we can talk about doing multiple. Those can be now considered not non-passive, or sorry, not passive, but actually non-passive. That's what I really meant to say. So now they're non-passive, and so now that non-passive short-term rental loss can offset that W-2 or business profit that you have. So that's usually the goal. That's usually the dilemma. And essentially that is the short-term rental strategy, really big picture. So Dave, do you want me to stop there, explain anything else?
Yeah, I'll plug in a couple questions and there'll be reiterations of questions that like Kim and I have had for you in the past. Let's say somebody has two properties or maybe three. Do they have to hit that at least 100 hours in each of the three properties and make sure it's more than anyone else, or say 500 hours in each property, or how can that all work?
Yep. The default answer to that is yes, you have to meet material participation in each property. That's a short-term rental, right? Again, what's a short-term rental? Anything with an average stay less than 7. Got to make sure it's only short-term rentals, not grouping and not thinking in long-term. So yes, the default is the answer is yes. However, you can group short-term rentals together under the 469-4 grouping election. That is an election that you make separately, separate statement on your tax return to say, hey, all these properties, they all meet the ability to group properties together. Therefore, I'm going to say, hey, I'll say 3 properties, right? Boom, boom, boom. Here's the addresses. I'm grouping them, IRS, and saying they're all essentially one activity. Sure, they're all different properties, but they're essentially all the same thing. I own them 100%. They're all short-term rentals. They're all in a similar geographic location, blah, blah, blah. Great. The IRS is going to say that's one activity. Then we can say, yep, across the 3 in my example, now we only have to hit 100 hours and more than anyone else. But across the 3, instead of, hey, 100 hours here, 100 hours here, 100 hours here, we can just group all of them if we elect to group them with the 469-4 election.
Awesome. I think that's a really helpful distinction for people. Um, what I want to do, Jeff asked a great question, actually two, and it sort of parlays into Kim. So I'm going to ask Jeff's question, his first question first. We'll answer it, and then I'll go into his second and sort of blend it with Kim's. So Jeff asked, and Jeff's managing properties, he said, collecting and remitting taxes for direct booking. Do we need to be the registered agent to remit the taxes throughout the US? Jeff, feel free to unmute yourself and just expand on that as it relates to the short-term rental tax stuff that we have here.
Appreciate it. Thank you. And Ryan, this is great stuff. And my second question, you probably answered while you were talking, so you don't have to go into detail there. but we have a short-term rental that does not remit for us in Fallbrook, Ohio, upstate New York, and we're collecting the money. We haven't remitted the taxes. Our fault. We honestly don't know where to start. So I read somewhere that we need to be like registered as an agent to do it, but I just don't know where to start there. So I don't know anything about that.
Yeah, so any form of remitting taxes, if it's sales tax, lodging tax, county tax, whatever, I just go say use Avalara. Avalara is just like I don't think free, right? But it's a tax compliance software. So I'd say go use that, plug in what you have, plug in kind of what you think you need. They have customer service, they can help you a little bit there. I just go say use Avalara. And even if it's like you're just helping a host, right? You're not maybe the owner, you might just need to do some work on your end to kind of say, hey, we're going to use this. I just need this information to kind of get you up and running. Avalara will do everything from there. Set it up once. My understanding is boom, it's done. So your kind of registered agent question, I'm not sure. It's usually like a legal thing for like LLCs. This is kind of a totally different thing from what you're talking about. I don't think you need a registered agent, and I just look at Avalara.
Perfect. Thank you.
Yep.
And I want to ask Jeff's second question because I think a lot of us managers fall into this or get this from our owners. He says, we have a client who wants to be, he's a big client. He wants to be listed as a co-host on our listing for tax purposes. He also wants us to send him our time spent managing his property weekly. And he's going to do what he has to do for tax deductions. Are we at risk of anything? And I just want to parlay Kim's question into that. She said, what are some examples of activities you do for those 100+ hours or 500 hours? Because maybe that helps answer this a little bit.
Yep. So Jeff, your question first. So simply having the owner of the real estate sounds like you may be our client because we actually tell people to do that and then reach out to their co-host or property manager to get that information. So point is like if he's a co-host with you on Airbnb, VRBO, wherever, or direct booking, that in and of itself isn't going to do anything because it's all about time. And that's why he's asking you for time, for example. So that's good because what he's trying to do, or she, I don't know, I'm just saying is he, but what he or she is trying to do is say, hey, you've got this much time. I've got this much time, right? I got more than you, right? And so he's trying to get everyone's time, which is great because he's trying to use that 100 hours and more than anyone else test. But again, simply putting yourself as the co-host isn't going to do anything. He actually needs to spend more time in the property. If becoming a co-host and getting connected there means, hey, he can respond to more guest messages, he can coordinate more cleaners, he's going to collect rent, he's going to do more things at the property, fantastic, right? Now he's a little bit more in the know and he can get more time and theoretically maybe you get less time, right? So now he has more of an ability, but simply the optics, how it's viewed, simply being a co-host isn't going to do anything. Okay. So hopefully that's clear. Is that good, Jeff? Is that what you're looking for?
That was good, but what about the fact that he wants to collect payments? Is that like a necessary thing for him to like do what he has to do for tax purposes? And also, can he just meet the 500-hour requirement for that?
Yep. So he could meet 500 hours and then who cares how much time anyone else gets? So that's absolutely an option. It sounded like he was looking for that 100-hour test, but yeah, if he gets above 500, all good. As far as like collecting rent, correct? Like collecting rent, not like collecting like taxes to be paid. Okay. Yeah, I mean that could be part of like his time in material participation just because Airbnb and all these things are so automated. I spend 0 seconds. I have a short-term rental. I spend 0 seconds every year doing any sort of collecting rent. So I just don't usually buy that a whole lot when people are like, oh, collecting, unless it's like a direct booking, right? Or we're like a mom and pop where it's like, hey, no, everything's cash or everything's check. And it's like a little bit more old school instead of all electronic. So he could do that. I just wouldn't want him to think that's going to be a whole lot of time unless, again, it's extremely manual. He's at the property talking to the tenant, collecting cash or collecting checks or whatever you're going to do. That could be, but that's probably not going to be a whole lot of time.
Okay, perfect. Thank you.
Helpful. Okay, now I'll go into Kim's question. So Kim's question was more so about type of activities that count. So I'll kind of make it as simple as possible. It's really two main categories. One is physical work that you're doing for the short-term rental. So think of any sort of like maybe you clean the property yourself, maybe you do any sort of repairs and improvements yourself, maybe you mow the grass or you do snow removal. That's the physical work at the property. That's crystal clear to the IRS. That is material participation and that will count, okay, towards your 100-hour test or your 500-hour test. But the other kind of main category still under material participation is management time. So what does management activities look like? Essentially, that's like setting up the Airbnb or VRBO listing, kind of online, the advertisement, right? We all got to put it up there. That would be talking to specifically Airbnb, like talking to guests. They're like, hey, this isn't working. Hey, this is broken, right? And just had a guest this morning say, hey, there's a leak in the basement. And it's like, oh my gosh, I got to deal with this. And that, takes 15 minutes. So stuff like that, where it's like, hey, you're communicating with guests, you're problem solving, you're troubleshooting what's going on with the property, or any sort of, taking care of stuff as it relates to the guests and you being the host, right? So you could be collecting rents, right? That could be part of that. Or if it's like you're having to kick someone out or anything that's dealing with management like that, that's all going to count. So again, big picture, physical repair work and management activities there. Those are all part of like what would be considered material participation. I see a question here, Dave. I'm just going to answer it.
Yeah.
Time. Let me talk about time that does not count, because this is usually where we get a ton of activities or questions. So essentially, I'll just say three main things that do not count. Time traveling. Okay. Travel time. I like to say that time travel is if we're going back in time or forward. But anyway, time traveling does not count, or commuting, whatever word you want to use there. The second one would be education time. So all of you on here, this is not material participation, right? This is like the IRS saying, hey, congrats, you went to this thing to learn. What in the world did you do for your property, right? It's too vague. It's too squishy to say like, yeah, that's really clearly time that you spent for your property. It's too vague, okay? So time, traveling, education, investor hours would be another one. So investor hours would be things like you have, say, a property manager, and you're kind of just looking over maybe some statements that they send you. Or it would be something like, what would be another example? Like looking for, or actually that's research. So the fourth one, that's what I was looking for in my head. The fourth one is research time. Research time would be things like looking for a property, that's like due diligence. That time's not going to count. Or if you're looking, say, for a cleaner, right? You're looking for cleaners in your area, simply the time getting quotes, contacting cleaners, that kind of stuff, that's also not going to count. But the big one that specifically came up was time that you're traveling or commuting. That is not going to count.
Super helpful. Can I ask another question? I know Kim and I had this summer, and I think it'll help a lot of people because it drove decisions we made for ourselves this summer. What's the maximum amount of time a homeowner that wants to claim material participation, what's the maximum amount of time they're technically allowed to use the property in a given year? And what happens if they go over that amount?
Yep. So
I asked Ryan this question in June.
and oftentimes it's too late.
Yeah.
I actually have a client that's emailing me. I literally just sent 45 minutes ago. That's like, you didn't explain this to me. And I'm like, no, I did. It's just that we talked about it a year ago. So, so point is, you've got really two things that I'll highlight. Okay. What Dave's talking about is personally using the property. Okay. Staying at your own Airbnb, VRBO, whatever. Let me just mention too, before I say, you just staying there personally, this could include family. Okay. Or this could include friends who stay there for free. Okay. So you need to be very careful of just, oh, you can't just silo it just to you to think, oh, I'm good here as long as I don't use it. I can have my friends stay there, my family stay there for free. That's not going to work. Okay. That's personal use as well. But really what Dave's getting at is kind of this, the 14 days or 10% threshold. Okay. A lot of people have heard about this threshold. Oh, and they hear it and they're like, oh, great. As long as I stay there less than 14 days or 10%, I'm good. That's all they say. No, there's another step there, right? So to be clear on what the 14 days, 10% is, if you say, stay at your property for 25 days, right? And you rent the property for 200 days. Okay. Obviously we've gone beyond either 14 days or 10%. That's maybe 15% or whatever that comes to, a little bit less, right? So we've gone beyond the 14 days, 10% threshold. What the IRS is going to do is say that's essentially a personal property. Okay. You've used it too much to say that this is exclusively a rental property. And therefore, what they say is any losses you generate from that short-term rental property that year, you cannot take. Period. End of story. Okay. Any losses you generate, gone. Okay. At least that for that year. You can suspend them for the next year potentially, but just know that you cannot take losses that year. And again, remember to the beginning of our conversation, that's usually the whole point we're doing this. Okay. So a lot of people get to filing their taxes and they're like, oh yeah, I stayed there for 25 days. And we're like, sorry, you literally can't take any of this. And it completely blows up their plan. Okay. Usually people are coming to us after the fact, like when we're helping them, it's like, sorry. But now let's talk about a different example. What if we only stay there for like 7 days? Okay. And we rent the property for 200 days. Now we're below that 14-day 10% rule. Okay. So some people think I'm in the clear, I'm good. That's not true. Okay. The reason it's not true is because what you have to do is now take the percentage that of the days that you used it personally and compare that to the percentage that you rented it. Okay. Now let's just say for the example, the numbers work out where it's 5% personal and 95% rental. Now what we have to do, again, we can take losses. That's good because we're underneath the 14 days, 10%. But now what we have to do is take our expenses, and now we can only deduct 95%. Let's take depreciation, for example. Now we can only deduct 95% of that depreciation compared to 100%. So now we've got less deductions and expenses, and now we're either showing less of a loss or we're showing more profit, right? Imagine I stripped away a bunch of your expenses and your deductions. You now have more income to show, right? Or less of a loss. So now you've increased your tax liability. So I just like to always mention that nuance. Again, some people are like, oh, I spend 1 day, it's fine. 7 days, it's fine. As long as it's under 14 days, 10%, I'm good. That's not true. You still have to do this allocation between personal and rental.
Diana asked an awesome follow-up question to that, which was, what if when I stay there, I'm doing work, yard work, maintenance, things like that?
Yep. So the general rule is a personal day is anytime as let's just say it's one person to keep it as simple as possible. Okay. I think you said Diana. So Diana is there
Yep.
at her short-term rental and she's like, hey, I'm gonna stay the night, but I'm gonna work, say it's a Saturday, like Friday night to Saturday or something. I'm gonna work essentially all day Saturday and then I'm gonna leave Saturday night. Right. So I'm only staying there 1 day. I probably would not consider that a personal use day because you are going there to work. That is considered now a business day compared to a personal use day. Okay. So essentially, the numbers, if we're going to try to move this kind of like a really clear line, what we have kind of seen is that you need to spend at minimum 4 hours for a day to now be considered business. Okay. And when we say business, some people will be like, oh, I'll just work for my W-2 job, but I'll stay at the property. Okay. Don't get cute here. Don't be trying to get too smart. Okay. You're going to lose because you got to work for that property, right? You got to work for that property to say, hey, I was here in order to work for this property. I did 4 hours of improvements. I was cleaning. I was changing out furniture. I was replacing this. I was restocking supplies. All of that stuff's good. That's also material participation. But now we can say, hey, I spent most of the working day, again, more than 4 hours. That's now a business day. That's not a personal use day. Okay. So if we drop below that, or if you've got, say it's you and your spouse, just one of you works 4 hours and the other spouse doesn't do anything, that's a personal use day. Okay. Every adult who's there needs to spend 4 hours or more for that to be business.
I love hearing a lot of this because I think that a lot of folks go into buying short-term rentals, especially I'll use ourselves as an example. We bought our home without even knowing a lot of the tax opportunities. So it was a few years down the road that we started learning, but it can be oversimplified. And I remember the very first thing, I'll never forget this. It had to be within the first 10 minutes of us ever talking. You're like, achieving material participation is hard, and it's supposed to be hard.
Yep.
And I couldn't agree more, but it was really, really helpful, so for context for folks, Kim and I want to use our home in Cape Cod this summer, pretty much the entire summer, and we essentially had to make the decision and say, the 30 grand that we're going to still collect on it, pretty much none of that is tax deductible, if anything. Now, great question. I think a lot of people sort of this falls under the getting too cute, but I want to ask this is how does the IRS know if you're at your house or not? Who
Huh.
are they to say?
I think I get that question literally every time this conversation comes up. So let me just say, for one example, there was a court case. Okay. Again, someone trying to get really cute and thinking that they're always right, and they ended up losing, which is great. People sometimes need to be just put in their place and when they're wrong. But at the end of the day, this taxpayer was basically like, "Hey, I wasn't at my property for these amount of days, and I had all this material participation in my rental property." And basically, the court was like, "Great, um, let's see your bank account records and compare that to your time log." So the taxpayer was saying, "Hey, on my time log, I'm at the property here and here and here." Let's say, for example, like August 15th, 16th, 17th, 18th, and 19th. They pulled up their bank account, their credit card, and it said London, 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 and their properties in the US. And they're like, "Nope, don't believe you. Don't believe anything you've told us now at this point, because clearly you're lying. You're saying you're here, but you're actually here. Poof, gone. Here's your taxes you owe us. Here's the penalties. Here's the interest on top of that for all the back taxes you've done." So, point is, they will pull whatever the heck they want. They will ask for whatever the heck they want. They are the government. They will just ask for it. You don't have it. They will subpoena it, whatever it is, to basically say, "We don't believe you, so give us more information." Okay. So point is like, sure, you might be like, "Hey, I'm getting away with this. How are they going to know?" Whatever. We've got texts, we've got bank accounts, we've got phone numbers, we've got social media. There are so many things online that they can be like, "Oh, where are you at? Where are you at? Where are you at? Where are you at?" Right? And they will try to pinpoint to say, "Nope, you're actually here." It doesn't make sense, right? But then you might say, "Well, how do they know I'm at the property actually working?" Okay. What you might want to do is actually take pictures of the work that you did for your own material participation log, right? Because then they're going to say, "You didn't spend any money for this property. Did you already have all the supplies there? All the improvements you say that you were doing? Was that already just stowed away in some shed or garage somewhere?" And if you don't really have a good answer, they're going to say, "We don't believe you," right? Everything is about, can you prove it? And just to keep something in mind too, when you think about the difference between a criminal court case and a tax court case, I think I told you guys this too. When you go to a criminal court case, you are innocent until proven guilty. Completely flipped with a tax court case. Okay. The tax court case says you are guilty. We don't believe you. You can't prove this deduction. You can't prove that you met material participation. You can't prove that. Go ahead and try to prove it. Otherwise, you lose. Right. So, point is, documentation is extremely key. And if you can't prove that with a time log, a receipt, your bank account, whatever it is, you lose. Right. And so that's one of the biggest hurdles for people who are serious about this, is having all the documentation, having everything lined up, and having everything ready to go. And especially before you even get audited, right? Because if you're going to get audited, we're helping several people right now with audits, and it's like, "Hey, here's your letter. We'll talk to you in 2 weeks." And it's like, whoa, that's really fast, right? And basically, if you don't respond within that time, a lot of negative things start to happen and spiral out of control. So, point is, like, you got to be ready to go. You got to have your documentation ready now, compared to, "Hey, I'm fine. I'm not going to do anything." And now I'm trying to bring it back to our main point of our topic here, because I feel like I got
Yeah.
off track. But I'll stop.
It's all
There's a
good.
lot there that we need to unpack, and I'll stop.
No, I love it. I think it's really helpful context. And again, it's not that any of this stuff isn't achievable,
Correct.
but it's just, having the right pieces in place. And for us, working with Ryan was really helpful to understand, the first year that we took major deductions on our house in Maine, which were totally valid, except for the fact that Kim and I never put together a time log because we never knew that we had to. And thankfully, it was before we had virtual assistants and a big robust team, so it was pretty easy for us to put it together. And we talked to the cleaners and kind of deduced about how much time they were in there. We had the lock information from the in and out on the locks to figure all that out. But, you know, all these tools that we have that can be really helpful, like automated locks, cameras, StayFi, where people put their email in, like even when you get on the internet, just remember that these are also things that pretty much anyone can have access to as it relates to the government if they want something. So just being really on top of it. And as long as you go into this stuff with the best of intentions, and a good solid game plan that's supported, like, one of the things we learned about Hall CPA is all the information that Ryan was sharing with us came from court documents. They've combed through a lot of that stuff. And so it was really helpful for us to understand that. And it was kind of scary that we were flying blind for almost 5 years, 6 years until we met Ryan and worked with Hall CPA. So it can just be super, super helpful. And another misconception I'll share that I at least had, because there might be some real estate agents on this call. I'm a real estate agent in Massachusetts, and I had this misconception thinking that, well, I work in real estate full time, I have rep status, and that none of this stuff even matters. And that was totally false. Not only was it wrong for the totally irrelevant for this asset class, but it was just wrong. And that stuff I had heard on like Bigger Pockets and other things. So I don't know if you want to just touch on reps real quick, Ryan, just to give people that distinction, because they might have owners that think that, or they might be an agent themselves.
Yeah. And then do you want to talk about like cost segregation studies and depreciation
Yeah.
next? Okay.
Yeah, we'll jump right into that for
Cool.
sure.
So reps, real estate professional status, again, that's really focused on long-term rentals, and that's one of the other ways you can take real estate, rental properties, and move them from being in that passive bucket to the non-passive bucket. Now, again, the big distinction there is that number one, with reps, we're talking about long-term rentals, but there's actually two additional requirements that are very different than the short-term rental strategy. Okay. So what I'm going to do, the way I like to explain it, if I've already said the short-term rental strategy, is essentially I just want to say, take the two tests that I had for the short-term rental strategy, right? Material participation in your short-term rentals. That's what we've been talking about, 100 hours and 500 hours. And the first one was that 7-day test. Essentially, take the 7-day test, take that out, okay, for real estate professional status. And we're just going to bring in two different things, okay? Number one is that you work 750 hours in a real property trade or business, and it's more than half your working time is in that real property trade or business compared to any other personal services that you do. Okay. So you still have material participation, but again, the distinction is take out short-term rentals, insert long-term rentals. Okay. That's the reps distinctions there. But the whole thing about 750 hours, more than half your time, yes, it's true that agents could easily meet that if they're working as a real estate agent full time. That's a real property trader business. Absolutely. Right. But the distinction then, or the difficulty, the barrier for people like that, for agents, is that the second step is time in your long-term rentals, not your short-term rentals, right? And especially for those of you who have, say, property managers for your long-term rentals, that can be very, very, very difficult to do because, again, the IRS knows by default, these things don't take a lot of time, especially if you have a property manager, or especially if you got one property, two properties, three, right? They know that maybe the more properties you have, that can be easier to accumulate, again, material participation, 100 hours or 500 hours, right? But that's only long-term rentals. Whereas short-term rentals can have all sorts of time. Every week, you're like, you got to clean, you got this thing to fix, you got to check in on this. I guess it's like, hey, I'm checking out. How do I do this? Where does the garbage go? Where does the recycling go? All those things. Hey, you can have time every week, right? A long-term rental, you've got one tenant a full year. You might talk to them every once in a while because something breaks. Okay, that's fixed. Okay, great. I'll talk to you in 6 months, right? They're still paying, they're paying, and it is really passive, right? So basically the IRS said, because we know it's so darn passive, you got to have these other requirements, 750 hours and more than half your time in a real property trader business. I will just say, for those of you listening, if you have two W-2 employees who are doing something completely outside real estate, not going to work. Okay. There's a lot of people out there who try to claim reps and it doesn't work. Okay. Or one of my favorites, but least favorites is really sad, is that you will put on your tax return that you claimed real estate professional status. Everything on your return will show them as long-term rentals. And in the end, they're actually short-term rentals and you're not trying to use real estate professional status, but you have no idea how to put that in on yourself for your own tax return. Boom, here comes the audit, right? So it's like so easy for them to just, IRS has all this software, right? hey, you've got two W-2s, you're claiming reps, you've got losses, boom, here's your audit, right? So easy for them to just automate and send these things out. And people are losing all the time because they don't understand it. They're not putting it in correct. They're using TurboTax, not taking my course that I put together, little pitch there, for short-term rentals specifically. So at the end of the day, there's a lot of distinctions there. The main one is 750 hours more than half your time. It's only for long-term rentals, and people get this confused all the time. There are distinctions. It's fairly clear to us. So don't get that confused.
Super, super helpful. And just real quick before we jump in, I know we're coming up to the end of the hour. I can stay on for a few more minutes. Do you have a hard stop, Ryan?
I do have a call at 12 Central. I told him I'd
Cool.
be a little bit late, so I have a couple.
Awesome. Real quick, would you be able to just share your email and or the
Yeah.
best way for people to reach you? Either put it in say it here, put it in the chat as well, and then we'll finish up. And anyone that can stay on for maybe 2 or 3 more minutes, this could be 6 hour situation. So, we'll keep it tight for people. But yeah, if you could just put that in the chat and then just share, verbally the best way for people to reach you, and then we'll carry on and share it once more at the end.
Yeah, so two ways. I'm going to put in the chat a link to a website, which is where you can fill out a form to basically fill out like, hey, here's who we are, email, number of properties we have, kind of income range, here's what we're looking for. That's in the chat. It's just therealestatecpa.com/RC, as in my initials, Ryan Carriere. But you also could, if you don't want to go that way, you just want to reach out to me directly, that's fine. I always prefer the form. But my email, I won't take tax questions, just to be clear. I only do tax questions for people who actually pay me.
Yeah.
This stuff is free, okay? You can take this for what it is. If you want personal one-on-one advice, your situation, what questions you have, does this work for me? That you can email me at ryan.carriere. You can see my name here at hallcpallc.com. So that would be my email. Always prefer the form just to kind of get you going in there. And you can always say, hey, I listened to Ryan on, this short-term rental thing. Then that's fine too.
Awesome. And we'll send a follow-up email to everybody that was registered, because I know, a good chunk of people didn't get to make it. And we'll share it that way also.
Sweet.
So Ryan, let's talk about cost seg studies, accelerated depreciation, and everything you get once you achieve material participation.
Yeah. So if you meet the short-term rental strategy and you have met that material participation and average stay less than 7, we've met the whole test. Now, again, we've moved from passive to non-passive. So what you want to do, especially in that first year, usually, is we're kind of timing all of this depreciation that we can get, aka accelerated depreciation, aka coming from bonus depreciation, which came from the Tax Cuts and Jobs Act of 2017. Okay. What you want to do is do something called a cost segregation study. Okay. Just to note, we're not a cost segregation study firm. We would kind of point you to people who would be a good fit, based on the size of your property, your tax rate, and things like that. We kind of try to pinpoint like, hey, go work with these couple people. Here's 3 people to reach out to. But you would get a cost segregation study done. Okay. So just really quickly, because we just got a few minutes, what is a cost segregation study? Essentially, it is going to break out. So short-term rentals, depreciation is over 39 years for the building. Okay. When you buy a new property, you've got to split out for tax purposes the difference in your cost between land and building. Land you cannot depreciate. Okay, so this is all building depreciation itself. So what we're going to do is, instead of depreciating the whole building over 39 years, you're going to depreciate some of it now over 5 years, over 15 years, and still some of it over 39 years. Okay, so why does that matter? That matters because now the 5 and the 15-year property are eligible for bonus depreciation. That's that accelerated depreciation that we can take from our short-term rental. Okay. So where we're at today with the whole Tax Cuts and Jobs Act, people have probably heard depreciation is going away, sort of. What we've had from kind of 2018 to 2022 is 100% bonus depreciation, meaning 100% of the cost in the 5 and 15 you could deduct immediately. But where we're at today is basically since 2023 and onward, it's been decreasing by 20% every year till we get to 0% in 2027. So 2024 here, you buy a new property this year, you place it in service, you meet this strategy, you're looking at today 60%. Bonus depreciation, meaning 60% of the 5 and 15-year property categories, you can only, in the first year, take 60% of that. The question I get often is, what about the other 40%? The other 40%, you will be depreciating over 5 years or over 15 years. Okay. So you still get it. It's just not as sweet as, hey, boom, all of this in the first year. It's kind of this huge spike in depreciation that we get. Now, one question I get is this legal? Absolutely. They've been around for decades. The IRS has audit tested this, like all of this stuff. They have a whole technique guide, audit technique guide, the IRS, just how to audit like cost segregation studies. So yes, it's out there. It's all legit. They know how to audit it, and it's fine. But that's what it's doing. Again, breaking out costs that you normally would have depreciated over 39 years, now moving a big chunk, usually 20 to 30% for residential properties, into now 5 and 15. And that amount there, you can now accelerate into the current year instead of waiting that 39 years to take all this depreciation, right? So that's really what it's doing. And kind of why it's important is because it's eligible for bonus depreciation now based on the new categories of assets that we just received from the study.
Now, Ryan, real quick, what happens? You have a brand new house, you close on it in Q4 of 2024. This is very common, especially in the New England markets I'm in. You're self-managing throughout the rest of the year and you meet all of the requirements. And that depreciation, far exceeds the revenue by $100,000. What does that mean for the homeowner?
Yeah, so that's good. That's fantastic. I know it might seem kind of scary because like, oh my gosh, I have this huge loss. Is that really true? What's going on? Well, it's a tax loss, right? So you might have net operating income that's maybe you're flat. But then let's say you do this cost segregation study and all of a sudden on your tax return you see negative 100,000. That is good for tax purposes, right? Because what we're now going to be able to do if we've met the short-term rental strategy and we've got this $100,000 loss, now we can, right, going back to the very beginning of this conversation, now we can take that to offset our W-2 and business profit that we have. So now this just takes some simple math. We've got a $100,000 loss that now we can use because we've met this, we've done a cost seg, right, kind of this combo strategy. Now what we can do is say we're in like the 35% bracket, 100,000 times 35%, that's a $35,000 tax savings because we've done this. Meaning that could equate to $35,000 back in the form of a refund. Or if you're someone who's a business owner only and you have to pay in all the time, that can mean $35,000 less that you have to pay in. Or it just really depends on withholdings, right? Depending on how much you withheld and whatnot. But at the end of the day, that $35,000 in tax savings is completely irregardless. That number doesn't change because of what we're getting here, right? We're getting additional losses. So now we have less of a tax liability, potentially in the form of a tax refund.
And what's really cool is, if you have a brand new house that is hundreds, worth hundreds of thousands of dollars, all new appliances, new hot tub, all the things, and you only have it the home in service for maybe a month, 2 months, maybe you collect 20K in revenue.
Yep.
Truthfully, with that 60% depreciation, it could be several $100,000 of a loss. You know what I mean? It can be really significant. And I think really that's the magic of short-term rentals. And, who knows if it'll go back to 100% depreciation or not, but, at least for what you have this year, quite significant.
Agreed. Yep. And who knows? Like we'll have a election coming up here, and usually laws change because we have elections. So who knows if anything might change there, but certainly that's actually been on the table as a conversation for our lawmakers this year. Do we increase 100%? Do we keep it at what it is? So just know, anyone listening, they've been talking about this. Like this is a big deal, especially for real estate investors. We're keeping an eagle eye on like whether this is going to change or not. So absolutely, it's going down 20% every year. Get in now if you're looking for tax savings. Now is better than next year, theoretically, unless they're just like, hey, this only applies to 2025. And we'd be like, oh my gosh, well, we couldn't have planned for that, right?
Sure.
But it would only be better. It'd only be great if it did impact us. So absolutely. Awesome. Yep. Really good.
And the very last question I'll ask, and then I think we'll cap it at that because I know everyone's got to get going. Let's say somebody bought the home in 2020 and they've never done a cost seg, and they would meet all the things to hit material participation. Here we are towards the back end of 2024. What would happen if they decide to do the cost seg now? Would it be 60% or would it be 100% because of when they bought the home?
Yeah, I love that question because it's 100%. So the percentage that you get is the year that it was placed in service, right? So yeah, if you've got a property you've never done a cost seg on, and even if you meet short-term rental strategy this year, but you put it in service 4 years ago, hey, consider doing a cost segregation study because you've got 100% sitting there, right? The nuance there from a tax perspective is you need to file Form 3115 with your tax return that year to say, hey, IRS, I'm changing my depreciation because I got this study done, right? Now I've got a whole new set of depreciation in 5 year and 15, and I'm redoing it. You're telling them that. So now I've got this amount of additional deductions that I'm taking this year. So you got to have that additional form, but absolutely it's 100% because it's the year it's placed in service.
Awesome. All right. Well, I think that's a good one for us to end it on.
Yep.
Once again, to anyone that's listening or listening to the recording or on this call, like I said, Kim and I really don't make any real big financial decision until we at least hit up Ryan and get an email going back and forth on it. And it's been super, super helpful for us. So I'm glad that a lot of folks got to tap into, some of the knowledge that we've been so fortunate to have. And, real last question, Ryan, once again, how can people reach you? And again, we'll send an email out to everyone as well.
Yeah, you can either go to realestatecpa.com/RC if you're just like, hey, I'm just ready to like see if I'm a good fit for you guys. We don't take everyone. Not everyone is necessarily qualified. So we'd kind of vet you first to see if we can provide you enough tax savings to say, hey, yeah, it's worth working with us. So don't feel ashamed or embarrassed. If you want to just fill it out and you're not sure, that's fine. But secondly would be my email, ryan.carriere@hallcpallc.com. Or find me on LinkedIn. I'm posting all the time. Yeah, so find me on there if you want to see like content that I'm posting out there. A lot of these same strategies, nuances, other things way beyond this that we deal with.
Ryan's LinkedIn is massively helpful. So I'll actually add a link to that in the
Cool.
follow-up email too. So, well, Ryan, thanks so much for your time today. Super, super appreciate you. And thanks for everyone listening. And we'll catch you on the next one. Take care, everyone.
Thanks, Dave. Bye-bye.